Good morning. Welcome to Forex In Four. Today is Thursday, October 13th, 2011. All right, this morning we're taking a look here, starting off with the Aussie, and the reason we're doing so is because we've got a little bit of risk aversion going on in the market, but you can see it's not taking a toll on the Australian dollar quite just yet. Now, they had their employment report come in overnight, and it came in a lot better than expected. Okay, they showed a gain of 20,500 jobs. They were expecting a gain of 10,000 jobs, all right, and that reduced the unemployment rate to 5.2% from the previous 5.3%. So that's a nice thing in Australia. Okay, employment looks to be strong there. This puts people, more happy to take on a little bit of risk here and pick up the Aussie. But we do have some general risk aversion going on in the market, and that's because overnight China reported that their export growth has slowed to 17.1% from 24.5% last month to the expectation was 20.5%. This has pushed their trade surplus down to only 14.5 billion versus the expected 16 billion. And we know that China's been a major engine of growth, all right, and their currency, the RMB, the yuan, has been appreciating a bit here, but this thing still isn't moving anywhere near what it potentially should be. So yeah, they're slowing down, but they've been going like gangbusters for a while. They're trying to play catch up. They're the drivers of world growth right now. But this currency manipulation that they have going on has just been addressed by the Senate. They passed a bill, saying that they're potentially going to start a trade war with China if they don't revalue. And it's interesting because I've always known and thought that that China's been a major source of global imbalances. That's not to say that they can't do what's good for them, but which is what they do, but everybody else needs to do what's good for them as well. So I think the Senate bill is well-intentioned, but I just don't think the consequences are necessarily the right idea. And one of the things that I thought they potentially should have done is, instead of imposing trade sanctions, right, which all of a sudden now they're going to put sanctions on us, we're not going to get our exports out, is that we should take it out on the debt that we're owed. I mean, essentially, come up with a committee that says, okay, well, listen, you're undervalued by this amount. We'll give you an opportunity to move your currency there. If not, you don't have to. But when it's time for you to cash in your bonds that you own here in the U.S., we're going to give you back what we think your currency is worth. So, in other words, if you're 30% undervalued, all right, you're going to receive 30% less back. That doesn't actually affect the trade balance in any way, and of course, that would piss them off as well. But it's a different way of looking at it without actually igniting a trade war. So I hope that they take a look at that and see what's going on, because right now we can't really deal with slowing growth here in the global economy. So we can see the Aussies pulled back just a little bit, but I'll show you. Let's look at Euro here. Euro's also pulled back from yesterday. Okay, but we're not down that much. In Europe we had they came out and Italy had a bond auction. It didn't go as well as they would have liked, which is a little bit disappointing, especially considering that Italy's been in focus recently because of their debt to GDP ratio, even though they're the third largest economy in Europe. And actually, Berlusconi, the PM, he's in front of their Congress, and he's calling for a confidence vote just to put everybody back on the same page and sort of reassert his control and let everybody know that he's on top of the situation. All right, but what we did get out of the Eurozone this morning is we got some German CPI figures, which came in just a little bit hotter than expected, 2.9% versus 2.8%. All right, it's not a huge amount. All right, but what we also got was the European October monthly report, and this sort of put a damper on things because it was negative. Outlook doesn't look good, growth moderating, all these statements where, listen, these aren't things that we don't know, right? The problem that we have, obviously, is that, we've got like the next 2 weeks or 3 weeks between now and, this new Franco-Prussian agreement with Merkel and Sarkozy, where they say they're going to have this solution to the whole kit and caboodle, and Euro debt crisis has really got the markets on edge. So, every day that it goes by, it's sort of, like, it's kind of like you're in college and you get a paper that's due and you're up the night before cramming to get it in. Whoever, like, when you set a deadline like that, whoever did the thing 2 weeks early and was like, oh, okay, here's my paper. It doesn't usually happen. It's usually the other way around. So if these guys are going into the last final minutes coming up with it, it would be nice if they came out a little bit in advance and said, okay, here it is. Well, we figured it out, but I doubt we're going to see that. So still problems with European banks. All right, Geithner's on his way over there to try and exert a little pressure, and you hear everybody else complaining about it as well. Now, let's take a look here at dollar yen. All right, you can see dollar yen yesterday. All right, boom, nice move up above 77, but right back down as quick as that happens. Let's back it out a little bit to the hourly chart, so you can see that, here was the range we were trading, 77, say 76 and a half. We got the big move up, big move down. Well, overnight the Bank of Japan released the minutes to their rate policy meeting, and they're calling for further intervention. Potentially because of the strong yen, which is hurting exports and potentially hurting the economy. I mean, right now their economic numbers look good because they're still in rebuilding mode from the tsunami and the natural disasters, but eventually this is going to take a toll on the Japanese economy. So, and they mention Europe as well as being a detriment to overall global growth, and, Europe is a problem. I mean, until we get this thing hammered out, it's going to be an issue. So that's what we're seeing. But yesterday, here in the U.S., Bernanke's release of the Fed minutes from the meeting. All right, he wasn't expected to do anything, but it was just a release of the minutes. Those were a dud. All right, a lot of people, including myself, were expecting it to be a little bit more fireworks. Okay, the market to have a little bit better reaction. It was just sort of like the way the market reacted. I mean, we got up pretty early, and then we just sort of floundered around for a little while. Stocks were up, and then we sort of sold off towards the end of the day. The release came out around 2 p.m. Eastern time yesterday, and essentially it didn't really mention much more about further quantitative easing. So, people are starting to think, well, you know what, maybe this, when he said it to the Joint Economic Committee, all right, maybe he just said it because, markets were tanking, and he thought that would be a good way to stabilize and or get a little boost, which looks like exactly what happened. So, I think the market was expecting to see that, they were very close to QE3, and that boom, all of a sudden, the thing takes off like gangbusters, but that wasn't the case. So you got a little bit of selling and disappointment, and, that happened, so what? We got S&P right here. We're looking at just down under 1,200. So that's the thing, and you can see that's the risk aversion in the market, and it's just mild this morning. Okay, oil pulling back from these levels as well. 86 and change. We're now at 84. All right, and you got everybody else moving a little bit lower. We should have dollar moving up against CAD here. All right, but I think this is just a temporary respite. We got corporate earnings coming in. I think J.P. Morgan just came in. They beat the estimate, but the bar was lowered. I mean, I think they're lower than last time, but they did beat the estimate, so it's hard to say. But right now, I think people want to buy stocks if they can. They want to push markets higher going into the close of the year, and if this euro debt thing can get itself figured out, then I think we could see a huge rally. So we might be see people starting to nibble here. And trying to get long risk as we get closer to this supposed resolution to the euro debt deal. So later this morning we've got initial jobless claims. That's not going to be a big deal. We've got the U.S. trade balance, expected to see a trade deficit of $46 billion. Yeah, shock. So not much on the way of the news thing. I think the jobless claims, people have pretty much blown off here in the U.S. And we know about what's going on in Congress, and now it seems to everybody's in election mode right now, and nobody's getting anything done. But they did pass these free trade agreements, which have been sitting around for apparently 4 years. So I guess that's a good thing. We'll see what comes out of this China currency deal and what that does to global markets. But one of the things I was thinking about was that, if the Chinese currency should start to appreciate, then perhaps we could see gold move higher. All right, and this could be, if China decides that, they're losing value here as their currency goes up, that maybe they want to spend some of it, all right, and start buying commodities, which would now be cheaper to them. So we could see maybe oil spikes, maybe gold spikes, and that could be a driver of global inflation, which, Bernanke's been trying to get inflation going, it hasn't happened for him. So that might be the move, but we'll have to kind of wait and see what happens in China and what happens with this bill in the House, and then what they actually end up doing. So we're a little bit ways away from there, but I think the cage has been a little bit rattled a little bit more than China would like, and it's going to be time for them to act, I would think, fairly soon. So in any event, that's kind of what we're looking at today. I'm just going to follow stocks to see what's happening. You know what, we didn't look at the pound here. I apologize. The pound is off a little bit more than the rest, just because it's pulling back a little bit, and it's just because of the overall weakening economic picture in the UK. But just remember that, you know, the picture is getting weak there, but in the meantime, they're actually repairing their balance sheet. So it's a lot different than weakening and not repairing your balance sheet. So there's a vast difference here between the US and the UK, and it's amazing that economists don't pick up on it. I heard somebody say the other day, well, at least we're not the UK. Well, guess what? I think I'd much rather be the UK, because at least if you're going to, you know, decline your output and you're going to sort of pare back, at least you should be taking care of your bills and getting that stuff done. And that's sort of what the UK has been doing, is getting the country's balance sheet in order, whereas in the US we're declining, but we're actually adding debt. So that's a lot worse. So anyway, that's kind of what we're looking at. I think stocks will get a pop today. I think we could see a resumption of these moves, but you know, if not, be prepared to go the other way. Alrighty, folks, that's what I've got for today. Good trading to all.